Bitcoin has now been around for 15 years, and there has not been a Bitcoin 2.0. So there's no crypto 2.0. Bitcoin is the surviving chain. We recommended Bitcoin originally when it was around 1,000, and we recommended investors put 2%. And many people said it was, oh, it's a Ponzi scheme, and Bitcoin has become a $2 trillion asset.
Bitcoin's 15-year journey from a nascent technology to a $2 trillion asset underscores its staying power. Lee dismisses the notion of a Bitcoin 2.0, arguing that no competing crypto has managed to replicate its success. He emphasizes that Bitcoin's resilience, combined with growing institutional acceptance, cements its role as a strategic reserve asset. The U.S. government's commitment to Bitcoin as a reserve asset further validates its significance, making it a critical component of any forward-looking portfolio.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
There are probably room for more positive surprises in the first half because we have an incoming president that's very pro-business, probably the most pro-business president in modern times. And with so far the cabinet selections that the market is very happy with. So that should be providing room for investors to become optimistic, which they call animal spirits. And the second tailwind is the Fed is dovish. And what that means is the central bank is easing. So that's positive for stocks. The third is investors are cautious because almost everyone we talk to, including you, think that valuations are expensive, or because we've had 2 good years, next year has to be bad. So we know sentiment is cautious. Usually when people are cautious, then you bet against the caution.
I didn't say valuation expensive, it's not cheap. But anyway.
Yes, I'm not sure there's a difference, but and then the fourth is that we know mechanically there's a lot of cash on the sidelines. There's a lot of firepower. $7 trillion of cash on the sidelines. So I would see this as positive for the first half of next year. But it could be, maybe the S&P goes up to 7,500, right? I mean, I don't know. 7,000 is sort of just a guess. Bitcoin has now been around for 15 years, and there has not been a Bitcoin 2.0. So there's no crypto 2.0. Bitcoin is the surviving chain. And Bitcoin has become a $2 trillion asset, which never in financial history, has anything reached $2 trillion and then disappeared. So it's a different argument if it was $100 billion. The third is the U.S. government is reiterated its commitment to make Bitcoin a strategic reserve asset. That's not bad for the price of Bitcoin. So if someone is watching this and said, well, they don't understand Bitcoin, so they decide not to own it, it's a catastrophic way to look at markets because we recommended Bitcoin originally when it was around 1,000, and we recommended investors put 2%. And many people said they won't buy it until they understand it. And then we'd spend 2 years explaining to our clients why they should own some Bitcoin, and they still refuse to buy it. So I don't think if someone is not going to buy Bitcoin till they understand it, they may end up missing one of the biggest opportunities in their lifetime. I think many are just recognizing that they're being obtuse in the sense that they're being stubborn to be skeptical of it. I can tell you, people had many arguments against it for years. People said, oh, it's a Ponzi scheme. It only goes up because of the creation of stable coins. Or people said that Bitcoin is going to go to zero one day. Or they're going to say that, well, why doesn't someone create a new Bitcoin? I would say that it's the same attitude people had for stocks since 2009. At JP Morgan, we had made the argument in 2009, and this really helped us become very well known among the institutional world, was that we had said in February of 2009 that a new bull market was starting. but one that we think could be quite significant, that could last for decades. And we had shown that the bear market that was taking place was actually in severity almost as bad as the Great Depression. Many investors were skeptical for years. If you recall, from 2009 to even 2014, people said that was just a fake bull market due to the Fed, and they thought we'd eventually go back to 600 on the S&P. Well, by 2015, many people lost their jobs because they fought a bull market that had almost tripled in price. I think that's what's happening now in crypto, because as much as people saying it's not a legitimate asset class, the fact that the U.S. government's about to buy it really changes the discussion. Overweights for next year within the equity market. Number one is financials.
Financials. It's been good rally past couple of months, right?
Yeah, and that's our number one sector. Number two is industrials.
Industrial.
And number three is technology.
Okay, so tech plus cyclicals.
Yeah.
Okay.
But we also like small caps.
Okay.
And Bitcoin. So if I had to say what is our number one ideas, it's really financials, small caps, and Bitcoin.
And can you give us reasons why you why you believe that financial will continue to run?
Well, financials have been suppressed because of what I'd call financial repression. The Fed's been tight, so they're easing, and the bank stocks have done poorly since the pandemic. So there's a big catch up there. The Trump administration is going to be pro deregulation and also reduce the barriers to mergers. That's capital markets activity. That's bullish for financials. And financials, of course, are pretty sensitive to overall economic activity picking up. So that's why we like financials.
The Federal Reserve's approach to rate cuts will play a pivotal role in shaping market dynamics. Lee's preference for a measured pace of easing, with only one cut in 2025, underscores the importance of preserving future policy tools. By maintaining a cautious stance, the Fed can manage inflation expectations while supporting sustainable growth.
The S&P right now is around 6,000, and we think it's going to go to 7,000 by the middle of next year.
Okay, so by the middle of next year.
Yeah, and at the moment, it could change, but at the moment, we think the first half will be better than the second half.
So stronger first half and...
Yeah, and so the market could run out of steam in the second half.
Okay.
So consolidate. And so we end at 6,600.
Okay.
It's still 10% growth for the index.
Okay.
But
after 30% rally, that's pretty impressive, right?
Yes. But I think that that's maybe not as important as people to understand that what we're really saying is that after 2 years of 20% gains, the market probably gains again. Because most people think, well, if 2023 was so good and 2024 was so good, we can't have a good 2025.
Yeah. And the valuation is not cheap, right?
Well, I think almost everyone we talk to talks about valuation. And so when people worry about valuation, it's probably less of a problem because everyone talks about it.
Yeah, okay.
The bond market is pricing in 3 cuts next year. So they're expecting the Fed to make 75 basis points worth of interest rate reductions. Now, the current Fed funds is 4.75%. And neutral, let's say, is 2.75. So that's actually 2 percentage points of easing the Fed has to do, which is about 8 cuts. The question that markets have to deal with is how many of those 8 cuts happen in 2025? So they expect 3, which leaves 5 left for the rest of the easing cycle. I think the best case is the Fed to only do 1 cut next year.
Okay.
Because that leaves 7 cuts in the future. Which gives them a lot of firepower. So I would prefer, but it's not a prediction, to see the Fed pause. And the market might initially get worried, but then they'll realize it's quite bullish. Well, in 2024, I think the principal difference in our view versus the street was that we believed we were only in the second year of a recovery.
Okay.
So the Fed and their tightening cycle essentially created a rolling recession. You know, there was clearly a recession in housing and durable goods and auto sales. In any past cycle, that is a deep recession. And now the Fed is easing. So 2024, in our view, was really the second year of an expansion. Many people instead thought 2023 was the market getting ahead of itself, and 2024 would be payback. But instead, we're doing even better this year. I don't think most investors still have accepted that, because when I hear folks talk about the economy, they think we're late cycle.
I mean, I just listened to Mike Wilson on, I think, YouTube Bloomberg, and he was talking about late cycle. A lot of people.
Yeah, well, it's been a very expensive late cycle for people. You know, I think it's a disconnection from what people can really observe. You know, if someone talked to their neighbors the last few years, people have been cautious. That's usually not late cycle behavior. Companies have been cautious. The ISM has been depressed for 3 years. That's not late cycle. So as these indicators turn, actually, the economy could actually accelerate. Yeah, and that's our base case right now. It's because the ISM's been depressed for 3 years. And so if someone said the ISM the ISM is a widely followed index, Institute of Supply Management, and it's following what the purchasers in manufacturing are saying. And that's been below 50 for 3 years. Below 50 is basically contraction. If someone believes the ISM is going to get worse next year, industrials will do poorly. But if they believe that confidence is going to improve and manufacturing will expand, that's very bullish for industrials.
Lee challenges the conventional narrative of a late cycle economy, arguing that the current expansion is still in its early stages. He attributes this misperception to the rolling recession caused by the Fed's tightening cycle, which disproportionately impacted housing and durable goods. As these sectors recover, the broader economy is likely to accelerate, validating his optimistic outlook.